we know that we are done with portfolio theory. So quickly, before we begin CAPM, let's have one more illustration. You will recall in our last class, we solved only one question, and I told you that there are different ways the examiner can test you on portfolio. At all time, the return of each security should be given to you in percentage. But if in a question, the return is given in absolute number, that is, you are given the return in naira instead of percentage, then you need to convert it to percentage before you begin to calculate the expected return of the portfolio. So if that is the case, so let's have one more illustration within the next few minutes. Once we are done with the illustration, we will then move to capital asset pricing model. So let's have this illustration number 3. All right, let's have this illustration number 3. Okay, so you are told that Johnson has just won 100,000 naira from Baba Ijebu Lottery Limited and has decided for the interim to place the money on 2 securities X and Y for a period of 1 year. 60,000 naira is to be placed on security X and the balance of 40,000 on security Y. Okay, he has estimated returns, that is, cash flow to be received at the end of the year plus project value at that time. And the probability of the 3 possible states are as follows. Okay. So, required: A, calculate the expected return, variance, and standard deviation of each security. All right. B, calculate the covariance between the 2 securities and the correlation coefficient. C, what are the returns of his portfolio for each of the possible states, A, B, and C. Calculate the expected return, variance, and standard deviation of the portfolio from these figures. All right. Number D, using the general formulae for the mean return and variance of a 2 security portfolio, recompute the mean return, variance, and standard deviation of his portfolio. So requirement number 3, requirement number C, and D are the same thing. Examiner wants you to determine the return of the portfolio as well as the risk of the portfolio. So meaning that in number C, examiner was specific in the C part that, in the D, examiner was specific that you should use the general formulae. That is, you are supposed to use the algebraic method, or you are supposed to use formula to calculate the return of the portfolio and the risk of the portfolio. In that number C, is the same thing you want to calculate, but examiner did not tell you which method to use. So if in D, you have been told to use general formulae, it means in C, you are supposed to use the tabular method. Then number E, you are to, examiner is telling you that would your answers to D above be different if the correlation coefficient had been +1, +0.5, 0, or -1? What conclusion do you draw? Okay, what conclusion do you draw? So that is the question. The first one says you should calculate the expected return, variance, and standard deviation of each security. So to solve this question, first thing first, when you look at your probability, you will notice that for security X and Y, you are given the same probability. So because you have the same probability of occurrence, so it means that there's a relationship between security X and Y. That is the correlation coefficient. So in this case, you need to first of all calculate the covariance between security X and Y. Then you then calculate the correlation coefficient to know whether the relationship between security X and Y is positively or negatively correlated. So we'll come back to that one later on. again, when you look at the return given to you, the predicted return at the end of the year, you will notice that the return of security X and Y are given in absolute value instead of percentage. So in this case, you don't use under portfolio, you don't use, your return must be given to you in percentage, but because we are given in Naira, you need to convert it to percentage using a specific formula for you to be able to do that. So once you have your return in percentage, then you can then proceed to calculate the expected return, variance, and then the standard deviation of each security. So without wasting more time, let me stop sharing this and move to the working notes straight so that we can cover as much as possible. All right. Okay. So according to the question, we are told that Johnson has just won 100,000 naira from Baba Ijebo, and he has decided to put the money in the interim on two security X and Y for a period of 1 year. So 60,000 naira will be invested on security X, and then the balance of 40% or 40,000 naira will be invested on security Y. So first thing first, let's determine the proportion, okay, amount invested. All right, amount, this is solution to illustration 3. I think that's page, let me check, let me confirm. Page 94. Page 94 to 95. Okay, so first thing first, because we are not given the proportion invested on each of the security, so we need to determine that. All right, so I can say proportion of the amount or amount invested, proportion invested on, let me do this so, and we need to shorten so that we can move faster. All right, so let's determine proportion invested since we are not given. So in this case, I can then say for security X, we have invested 60,000 naira out of 100,000 naira. Therefore, to get the percentage invested on security X, we divide the amount, which is 60,000, divided by 100. That will give us 60%. Then for security Y, we are investing 40,000 naira out of 100,000. So that will give us 40%. Okay. Not only that, also in the question, the returns given to us are in Naira. They are in absolute value. So you need to convert it to percentage. All right. So conversion of return to percentage. Okay. To do this, return, anytime you are given the return in absolute number instead of percentage, you need to convert it to proportion or to percentage using this formula. To do this, you then say value at the end, value at the end of the period minus value at the beginning over value at the beginning. Okay. So multiply by 100%. So in this case, for each state of nature, so we are going to calculate for each security, starting from security X. For security X, state A, state of nature A will be computed as, I will then go back to the question. The value at the end is the amount you are investing in each of the security. You are investing, the value at the beginning is the amount you invested, which is 60,000 naira. Value at the end is given to you in the question. Predicted return at the end of the year for security X is 75,000 naira under the state of nature A. 75,000. Here is 75,000 minus value at the beginning, which is 60,000 naira you are investing on security X. Then divided by value at the beginning, 60,000, multiplied by 100 over 1. What do you have? Then in state B, under state B, value at the end is 73,200. So 73,200 minus 60,000 value at the beginning over value at the beginning, 60,000. Give me the percentage. What did you have?
The first one is 25.
The first one, 25.
Okay, value in this one is 25.
The second one is 22%.
22. Then for security X in state C, we have 67,200. 67,200 minus 60,000.
The percentage is 12%.
Okay, so 60,000 multiplied by 100 over 1. Here will be 12%. So we are done with security X. We do the same thing for security Y. All right. Security Y. Under state A. The value at the end for security Y is 45,600 at state A. 45,600.
The percentage is 12.5%.
Minus value at the beginning, 40,000 over value at the beginning, 40,000. You say is what?
12.5%.
12.5%. That is 5,600 divided by 40,000. So say 12.5. Then move on to state B. All right, state B.
Okay.
We are investing 47,200. Value at the end is 47,200 minus value at the beginning, 40,000 over 40,000.
The percentage is 18%.
Here is 18%. Then state C, value at the end is 48,000, right? 48,000 minus 40,000 over 48 over 40,000 multiplied by 100 over 1. What do you have here?
20%.
20% is that. Okay, so if that is the case,
Is 14%?
I think the
A
A is
14%.
14%. 14. A is 14%.
Okay, all right, thank you. Here is 14%. All right, then. So now that we have, please mute, everybody mute. Please mute. Now that we have the returns in percentage, we can then proceed to our calculation. Okay. So we need to determine, examiner is asking you in the A part of the question that you should calculate expected return, variance, and standard deviation of each security. So I can then say number A, expected, let's call this one A, Roman figure 1, expected return, variance, and standard deviation. So we are starting with security X. So you already know this. We have three states of nature. Then we create a column for probability. Then we have the return. We have the expected value. So here is P, here is X, P multiplied by X. Then we are going to have X minus X bar, X minus X bar squared, then probability of X minus X bar squared. All right. So we have three states of nature, which is state A, B, and C. The probability at state A is equal to 0.3. Here is 0.30, 0.45, and then 0.25. The return of security X under state A was calculated 25, 22, 12. 25, 22, 12. Okay, so to now get the expected value, you are supposed to multiply probability with the return. So 0.3 multiplied by 25 equals 7.5. The next one, 0.45 multiplied by 22 equal 9.9. Then for state C, 0.25 multiplied by 12 equal 3. Therefore, you add it together to get the expected return of security X. Return of security X okay, there is one. So 7.5, 3 plus 9.9 plus 7.5. So which give us 20.4. All right. The expected return of security X is 20.4. So to now get the variance of security X, we are supposed to extend, and which is what we have done in this table. So the variance of security X. So 25 minus 20.4.
I have 4.6.
4.6 square. What do you have?
21.16.
21.16.
Yes.
All right. Multiply by probability of 0.3. Moses, there is noise at the background at your hand. So Ruth, be giving me the number, please.
All right, sir. 6.348.
6.348. Then the second one, 22 minus 20.4.
1.6.
1.6 square.
2.56.
2.56. Multiplied by probability of 0.45.
1.152.
1.152. Then the next one, 12 minus 20.4.
8.4.
Minus 8.4 square.
Yes.
Minus 8.4 square, what do you have?
70.56.
70.56. Multiplied by a probability of 0.25.
17.64.
17.64. Add up the three.
All right. 25.14.
25.14. So the variance of security X is 25.14. So one more thing we need to calculate, which is it can't be 0.06348. Okay, do it again. 0.3 multiplied by 21.16 cannot give you 0.6348. That's not correct. So standard deviation of security X will be computed as the square root of variance, which is summation of probability of X minus X bar squared, equal to the square root of 25.14 is what?
5.01. 5.0.
5.01. So the standard deviation, the risk of security X is 5.01. So let's calculate for security Y the same way. So security Y all right. So states probability, then return of Y, then expected return, which is probability multiplied by Y. Then we have Y minus Y bar, Y minus Y bar square, then probability of Y minus Y bar square. Okay, state A, B, C. The probability remains the same as 0.3, 0.45, then 0.25. The return of security Y as computed by us is 14, 18, 20. 14, 18, then 20. So we need to determine the expected return. All right, expected return of security Y. Here will be the variance of security Y. Yes, let me see. Somebody is sending a chart. The first one is, no, I've already, that one is, you can do it again. It's not correct. The second one is saying page number. Rose Simon, it's page 94. The question is on page 94. Now, Ruth, give it to me. 0.3 multiplied by 14. What do you have?
4.2.
4.2. 0.45 multiplied by 18.
8.1.
8.1. 0.25 multiplied by 20.
5.
5. Add it up.
17.3.
17.3. So the expected return of security Y is 17.3. So let's calculate variance. 14 minus 17.3
3.3.
minus 3.3 square. Yeah.
10.89.
10 points
89.
multiplied by probability of 0.3.
3.267.
3.267. Okay. Then 18 minus 17.3.
8.1.
No. 18 minus 17.3.
0.7.
0. So 0.7 square.
That's
0.49, right? So multiply by 0.45.
0.2205.
0.2205.
0.2205.
Yes,
Okay. The last one, 20 minus 17.3.
2.7.
2.7 square.
7.29.
7 point what?
7.29.
Without rounding. Okay. So multiply by 0.25.
0.8225.
Check it. What do you say is the answer?
1.8.
8225.
Yes,
Add it up. What do you have?
5.31.
5.31 is the variance of security Y. So to now get the risk or standard deviation of security Y, standard deviation of Y will be equal to the square root of the variance of 5.31. So give it to me. What you get?
2.30.
2.30. So the risk of security Y is 2.30. When you look at our calculation, right? When you look at our calculation, you will see that security A, the return of security A is 20.4. The return of security A is 20.4. What's wrong with you? Connect. You have started again. My pen is not connecting. Let us see. Anyway,
So I think we need to lay hand on your pen. Oh.
you know, I think is I mistakenly I did something. That's why. Let me. ah, ah. So I think it's Moses that is causing this. Moses, don't allow the prayer warriors to deal with you. The prayer warriors. This is good. Okay, you know what? Just give me 1 minute. Let me just, I don't know why it's not connecting. And it's connecting on the PDF documents. Anyways, just give me 1 minute, please. Let me see. Let me try to. Anyway, let me just go out. Please, when I come back. So when you look at the return of security X, you will notice that return of security X is 20.4. The risk of security X is 5.01. Return of security Y is 17.3. Why the risk of security Y is 2.3, which is consistent with the notion that the higher the risk, the higher the return, and vice versa. Security X has a higher return and a higher risk relative to security Y with a lower return and then lower risk. So we have answered requirement number A. We then move to requirement number B, where you are asked to calculate the covariance between the two securities and the correlation coefficient. I explained to you last week that covariance measures the linear relationship between two variables. Anytime you want to determine the linear relationship between variables, then you calculate covariance. So number B, Roman figure 1, calculating covariance. Okay, covariance between securities X and Y. So to do this, covariance between X and Y will be computed as summation of probability of X minus X bar multiplied by Y minus Y bar. All right. So we have calculated all of this. So covariance is equal to, in this case, we are going to create a table. So for probability, then we create a table for X minus X bar, Y minus Y bar. All right, Y minus Y bar. Okay. So probability is 0.3, 0.45, 0.25. For our calculation, X minus X bar. X minus X bar, this is the figure you want to pick. For state A is 4.6, 1.6, then minus 8.4. 4.6, 1.6, minus 8.4. For Y minus Y bar, we have minus 3.3, 0.7, then 2.7. Minus 3.3, 2.7, is it 2.7 or 0.7? Let me confirm. 0.7 and then 2.7. So to now get the covariance, you are supposed to multiply the three of them. Covariance, let me shorten it, between X and Y. So you then multiply each of them. So what do you have? This is the covariance between X and Y. So what do you have?
The first one I have minus 4.554. I don't know if somebody else can check.
You have minus what?
Minus 4.554.
554. Okay. The second row, stage B.
0.5 0.504 minus
0.504, right? Is it
I think
0.504?
yes.
It's
That's
not
it.
minus. Oh
Yes,
yeah,
yes.
next one.
minus 5.67.
Minus 5.67. Add it up. Add everything together. What do you have? Minus,
Minus 9.72.
yeah, correct. Yes, Moses, what's your question? Talk to me.
Excuse me, sir. I can't. How did they get this minus 4.554? Please.
See the formula now, you are multiplying it. This is the formula. You are supposed to multiply the three of them. Probability of 0.3 multiplied by 4.6 multiplied by minus 0.3.3 minus 3.3. So it will give you minus 4.554. Right? Moses, is it clear?
I will try it out.
Okay. So B high. Calculating correlation coefficients. Sorry, yes, correlation coefficient. Whether examiner asks you or not, you have to do this. You know, I told you last week that when the probability of each of the securities are different, it means that there is no relationship between the securities. But if you are given the same probability, it means that there is a relationship. In that case, you need to compute the correlation coefficient. So in this question, we are given the same probability for security X and Y. It means that you have to compute correlation coefficient, which is computed as covariance between the two security X and Y over standard deviation of security X multiplied by standard deviation of security Y equal to, we have computed covariance to be minus 9.72 divided by standard deviation of security X. We calculated 5.01. Then standard deviation of security Y, we got 2.3. Therefore, you then say R equal to minus 972 divided by 5.01. Let's see, 5.01 multiplied by 2.3. That's 11.523. All right. So this will then give you minus 9.72.
84.
Pardon?
0.84.
Minus 0.84. So the relationship between security X and Y is negatively correlated. So we need to interpret our results. All right, even the examiner did not ask you, but it is implied. He then said the relationship between securities X and Y is highly negatively correlated. So if your correlation coefficient is above 50, it means it is highly correlated, provided your, let me write it down for you. Okay, provided your R is greater than 50 but less than 1, less than 100%. Let me put it this way. So greater than 0.50, but less than 1. Okay. So your interpretation should be that the relationship is either highly positively or negatively correlated, depending on your calculation. So if it is positive, if your correlation coefficient is positive, it will be highly positively correlated. If it is negative, it will be highly negatively correlated. Positively or negatively correlated. So that is for that one. But if it is less than 50, if R is less than 50, okay, if R is less than 50, it means that it is lowly, you can say the relationship between the two security is relatively or lowly positively or negatively correlated, depending on your calculation. Okay, but if your R is equal to perfect 1, either positive 1 or negative 1, either positive 1 or negative 1, then it means that the relationship between the two securities is perfectly positively or negatively correlated, depending on what you have calculated. So that's how to interpret your results. Now, that's what examiner asks you to calculate covariance. We have determined our covariance to be minus 9.72. We also determined the correlation coefficient, and we got minus 0.84. And we expressed our result to mean that the relationship between security X and Y is highly negatively correlated, which is good because for investors to minimize the risk of the portfolio, you must invest in securities that are negatively correlated. That's the primary objective of investor, to minimize portfolio risk. So you need to invest in securities that are negatively correlated. So that is for that. Hey, I wanted to spend just 30 or 45 minutes. We are spending close to 1 hour now. Imagine. So number C part of the question. In the C part of the question, examiner is asking you to calculate, right? You are asked that what are the returns of his portfolio for each of the possible states, right? So like I mentioned, examiner is asking you to calculate return. You also have to calculate the risk of the portfolio in that number C. So the same thing you are supposed to do in C and D. But in the D part, examiner was specific. You are asked to use the general formulae, meaning that you have to use formula. But that means in the C part, you are supposed to use the tabular method. So if that is the case, we can then say number C1, right? Number C Roman figure 1. We are going to combine the two of them together, both the return and then, so let me put it down for you. Calculating expected return. Expected return of the portfolio variance and risk. of the portfolio. Okay, so that's what examiner wants you to do in this number C. So like I said, because in the D part, examiner wants you to use the general formula. So it means that in this C, in this requirement number C, you are supposed to use the tabular method. To do this, you then say, let securities X and Y equal to, let's use any letter. Let's say like we did last time. So let security X and Y equal to A. Then you can see in this question, we have only one probability for security X and Y. So since you have only one probability, that means you are going to have three possible outcomes. So I will then call possible. Let's remove the possible, since it's only one. So just say states. So we have states A, B, and C. Create a column for working. Let me manage my space. You create a column for working, right? Then after working, we are going to, let's just do it once and for all. So you recall what we did last time when we were calculating the return of the portfolio and the standard deviation of the portfolio using the tabular method. You are supposed to keep the return of one security constant and you vary the other. But because in this question, we have only one probability for the two of them, so there is no need for you to keep one constant and then vary the other. So you then come here, we are investing 60% on X multiplied by the expected return of X. What did you calculate for expected return on X in state A? Ruth, are you still there?
Yes, sir.
What did we calculate as our expected return for security X?
20.4.
No, I mean the return. The return we
7.5.
calculate. No.
No,
The
25.
25, okay.
20.
25.
Okay.
Then for plus 40% for security X multiplied by what's the return of security X at state A?
14.
14, okay. I hope this space will be sufficient. Then for state B, 0.60 multiplied by what's return of state B for X?
22.
22 plus 40% multiplied by 18. Then 0.60 multiplied by
12.
12.
12.
Okay, plus 40% multiplied by 20. Okay, so that's that. I will then come here. The return. This is working for the return. Now that we have the return, what's the answer for the first one? What do you have? 0.6 multiplied by 25 plus 0.4 multiplied by 14.
20.6.
20.6. 20.6. So this return is A. Then 0.6 multiplied by 22 plus 0.4 multiplied by 18. All right.
19.4.
19.4.
20.
Which one is 20?
That same one. Let me recalculate. I don't know.
0.6. You just open a bracket. Open a bracket. 0.6 multiplied by 22. Close the bracket plus open another bracket. 0.4 multiplied by 18. Close the bracket. Equal. That's 20.4. This is not 19, it's 20.4.
0.4.
Then the last one is open a bracket, 0.6 multiplied by 12, close the bracket, plus open a bracket, 0.4 multiplied by 20, close the bracket, equal 15.2. Okay, that's the return. Then we need to get our probability, combined probability. So I will then come here probability, which is P. Okay. To get the same way we have combined the return is the same way we are going to combine the probability. Of course, you know we have the same probability for the three states. So here will be 0.3, 0.45, then 0.25. You have the same probability. Therefore, expected return, which is P multiplied by A. Let me manage that space. Okay, so this will then be the return of the portfolio, that is A bar. All right, so probability 20.6 multiplied by 0.3. What do you have? Okay, let me use my
6.18.
1.8.
6 point what?
1.8.
The next one, 20.4 multiplied by 0.45.
9.18.
9
So
point
the last one is 3.8.
3.8. So add it up. What do you have?
19.16.
19.16. So the return of the portfolio is 19.16. All right. So let's calculate the variance of the portfolio, which will be equal to A minus, which is A minus A bar. Let me manage this space. Then A minus A bar square. Then finally, probability multiplied by A minus A bar square. All right. So 20.6 minus 19.6. Let's be fast. Let's do it faster.
1.44.
1.44 square.
2.0736.
2.0736 multiplied by probability of 0.3.
0.62208.
08. So the next one is 20.4 minus 19.16.
1.24.
That's 1.24 square.
1.5376.
5676.
No, I said 1.5376.
Okay. They multiply by probability of 0.45.
That is 0.69129.
The last one, 15.2 minus 19.16.
3.96.
Minus 3.96 square.
That's minus 15.6816.
No, take it again.
Minus
Minus
15.6816. 6816.
Hold on. 15.2 minus 19.16 will give you minus
Minus 3
3.96.
point. Yes, sir.
So minus 3.96 square. What do you have?
Minus 15.6816.
No minus, so
15.6. There is no minus there.
Okay.
15.6816. Multiply by a probability of 0.25.
0.25.
3.9204.
204.
9 what?
9204.
So add it up. What do you have there?
5.2344.
5.2344, right? Did you say 5.2344?
Yes, sir.
Okay then. So that's the variance of the portfolio. To now get the risk of the portfolio denoted as DP, you are supposed to get the square root of the variance, which is 5.2344. Give it to me. What you get?
That is 5.234. If she's rounding it up, it's 5.234, not 44.
5.234.
5.234 because it's 5.23377. So if she's rounding it up, it's 5.234.
Okay. So 5.234 square root. What's the square root of that?
2.2877.
That's 2.29.
Yes, 2.29. Approximately.
The risk of the portfolio is 2.29. That's the standard deviation. So that answers number C. In the D part of the question, the examiner wants you to use algebraic. You are supposed to use general formulae to calculate the mean return variance of a two security portfolio, recompute the mean return variance. So examiner just wants you to calculate the return of the portfolio and that of and then the risk of the portfolio. So number D, let's say number D, Roman figure 1. D, Roman figure 1, calculating expected return of the portfolio. Whether you use the tabular method or you use algebraic method, you are supposed to get the same answer. So how do you then calculate the return of the portfolio using the formula, using general formulae? So the return of the portfolio is computed as the amount proportion invested on security X multiplied by expected return on security X plus proportion invested on security Y multiplied by expected return on security Y. So the return of the portfolio, we are investing 60% on X. We calculated expected return on security X to be, is it 20.4?
Yes, 20.4.
Okay, 20.4. All right, then plus, we're investing 40% on security Y multiplied by expected return on security Y, which is, I think, 17.3, right?
Yes, sir.
Yes, sir.
All right, so give it to me. What's the final answer? Use your calculator and give me the final answer. Open a bracket, 0.6 multiplied by 20.4, close the bracket, plus open another bracket, 0.4 multiplied by 17.3. Give it to me. Final answer. If you want to do it one by one, no problem.
19.16.
19.16. So D high, estimating or calculating portfolio risk. All right, so examiner says you should use the general formula to calculate the portfolio risk. So in this case, the portfolio risk will be computed as the proportion invested on security X, you scale it, multiply by the variance of X, plus proportion invested on Y, you square it, multiply by the variance of Y, plus 2, because we have security X and Y, so that means there are two asset portfolio, multiply by the proportion invested on X, multiply by the standard deviation of X. Proportion invested on Y, standard deviation of Y. Multiply by correlation coefficient between security X and Y. Okay, so that is the formula. Let me move to the next page. So in this case, the risk of the portfolio will then be equal to the square root, right? We're investing 60% on security X. So the square is multiplied by the variance of security X. What did we calculate for variance of security X?
25.14.
25.14 plus we're investing 40% on Y. So the square is, what's variance of security Y?
5.31.
5.31, okay, then plus 2, multiply by the standard, we are investing 60%. What's standard deviation of X? That's 5.01, multiply by, we are investing 40% on Y, multiply by 2.3.
Yes.
Then correlation coefficient, we calculated minus 0.84. 0.84. So that's that. You can see it's not difficult. Just know what you are doing. So this one will then be equal to, let me use calculator, 0.6 square. Okay, 0.6 square. Multiplied by 25.14. What do you get?
9.054. 9.0504.
9.0504 plus the next one. Point 4 square multiplied by 5.31.
0.8496.
8496 plus, then the other side, 2, let's do it this way. Because of requirement number, is it requirement number D or E? Let me check. Because of requirement number E, whereby examiner has told you that your correlation coefficient is 0.1, is a +1 plus 0.50 and then -1. So because of that, let's separate this other side into 2. So you are going to multiply this side together. You are going to leave the correlation coefficients. All right? So give it to me. That is, let's do it this way. 0.6 multiplied by 5.01. Let me go use
3.006.
3 point what?
006.
Everything.
No, that's It's only that 0.6 times 5.01.
No, combine the two. Use brackets. Use
Okay.
brackets. So open a bracket, 0.6 multiplied by 5.01. Close the brackets, then multiply by, open another bracket, 0.4 multiplied by 2.3. Close the brackets, equal, then multiply by 2, equal. So here is 5 points. 5 point, what did you get? Let me go back to my calculator. 53104. 53104. Then multiply by minus 0.84. The reason why we have to do it this way is because of that requirement number E, so that you don't need to be recalculating it. The only thing that will be changing will be the correlation coefficients. So on the left, you then add it up on the left, which is 9.0504 plus 0.8496 equal 9.9. Here is 9.9, then minus that positive will change to minus because you have minus 0.84. So I would then say 5.53104 multiplied by 0.84 minus. That's minus 4.6. Let me go back to my calculator. 6460. 6460. 736. 736. So this one will then be equal to, let me just type minus, okay, plus 9.9. So this will give us, what did I do? Oh, error. Okay, let me start all over then. 9.9 minus 4.6460736. I still did not do the right thing. 9.9 minus 4.64 736. So this is 5.25. 5.25 3926. 39264. Then find the square root. So find the square root. That's 2.29. 2.29. So you can see whether we use general formulae. When you look at the answer we got, when we use the tabular method, it's the same thing. Our return was 19.16. Standard deviation is 2.29. When we now use the table, when you use the formula, it's the same thing we got. It's the same thing. All right. So irrespective of the method that you use, you are supposed to get the same answer. So that answers number D. We are then go to the last one, which is E1. In the E1, examiner is asking you, would your answer to D above be different if the correlation coefficient had been positive 1? So in this case, I would then say R, where R is equal to positive 1. So what that simply means is that if your R is equal to positive 1, the only thing that will be changing on this other, on the right side, will be the correlation coefficient. All right. So in this case, I would then say the risk of the portfolio equal to 9.9. Okay, since my R is positive 1, so this 9.9 plus, open a bracket, 5.53104 multiplied by positive 1. Okay, then you find the square root. All right. So in this case, the risk of the portfolio will then be equal to 9.9 plus 5.53104. So find the square root. So I would then say 9.9 plus, sorry, 9.9. 9.9 plus 5.53104 equal, we have the square root of 15.43104. 43104. So final answer, just press square root. That's 3.93. 3.93. So that's that. Then the second one, high, where R equal to positive 0.5. Okay, so it's the same thing. The risk of the portfolio then will be equal to square root of 9.9 plus, open a bracket, 5.53 of 53104 multiplied by correlation coefficient is positive 0.5. Then you find the square root. So this should be equal to 5.53, 5.53104 multiplied by 0.5 equal. So here will be 9.9 plus
2.7
2 point what?
76552.
552. Add it up and give me the square root.
Okay. 3.55, 3.56.
3.56 is the final answer. Then the third one, where R is equal to 0. So if R is equal to 0, so it means that all other sides, the right side will be equal to 0. So dp equal to 9.9 plus, let me just put it there for you, 53104 multiplied by 0. So find the square root. In this case, it will be dp equal to square root of 9.9. So what's square root of 9.9? 9.9 square root.
0.15.
2.15.
3.
3.15. Okay. Then the last one, number 4, where R equal to -1. So the risk of the portfolio will be equal to the square root of 9.9 plus, open a bracket, 5.53104 multiplied by -1. Okay, multiply by -1. All right. So this will then give us 9.9 minus 5.53104. What do you have? 9.9 minus 5.53104. Okay.
4.36896.
4.36896.
4.36896. So what's the square root of that?
Square root of it is 2.1.
2.09.
2.09. All right. So examiner is now asking you, what conclusion do you draw? What conclusion do you draw? When you look at our calculation, when the correlation coefficient is perfect 1, the risk of the portfolio is 3.93. When the correlation coefficient reduced to 0.5, the risk also reduced to 3.56. When the correlation coefficient reduced further to 0, the risk of the portfolio reduced to 3.15, right? Then, again, the last one, when the correlation coefficient is negative perfect 1, then the risk of the portfolio reduced further to 2.09. Examiner is now asking you, what conclusion do you draw? The conclusion is that the higher the correlation coefficient, the higher the risk, and vice versa. That's all. So put it there. Conclusion. Okay. The as shown in the calculation in requirements E above, in requirements E above, the higher the correlation coefficient and covariance, the higher the portfolio risk, and vice versa. That's that. When the correlation coefficient is perfect 1, the risk of the portfolio was high. We got 3.96. When the correlation coefficient reduces to -1, the risk of the portfolio also reduced to 2.09. That's the conclusion. All right. So that's end of the question. That's it. I wanted to spend just 30 minutes or 45 minutes maximum. We ended up spending 1.5 hours. So let's spend the remaining hour that we have to explain capital asset pricing model. Let me know if you have any question for me before we talk about capital asset pricing model. Okay, any question? If there is no question, then let's move to CAPM, capital asset pricing model. Let's do it this way. To make it faster, is there anywhere I would like to use? Okay, let's just continue. Capital asset pricing model. Let me use the study material. Let me stop sharing this. Let me use the study material. If possible, we can solve through illustration today. At least that will be something. Let me use the material so that it will be faster instead of writing on the screen. So let's talk about capping. Yes, what do you understand by capital asset pricing model? The capital asset pricing model is just a continuation of the portfolio theory. It is a model that is designed to establish the relationship between the systematic risk and the expected return of an asset, that is stocks. Okay, I repeat, the capital asset pricing model is a model designed principally to establish the relationship between the systematic risk and expected return of a given asset. All right. The capital asset pricing model is used mainly for calculating cost of capital, determining expected return on assets, and at the same time establishing or it can also be used to price risky assets. All right, you can use capital asset pricing model to price risky assets, determine expected return on assets, and also estimating the cost of capital. You will recall that when we did cost of capital, I told you that under cost of equity, I said there are three different ways there are three methods of calculating cost of equity. You can use dividend valuation model, capital asset pricing model, and then Miller and Modigliani. So the capital asset pricing model of it, like I mentioned then, I said is a topic on its own, and that's what we are discussing now, right? So again, if you want to determine the expected return, you can use capital asset pricing model to do that. If you want to estimate the price of a risky asset, then you use capital asset pricing model. The most risky asset is shares. Okay, shares are the most risky asset, or stocks. America call it stocks. Then the British call it shares. All right, whether stocks or shares is the same thing. All right, whether you call it stocks or shares is the same thing we are referring to. Okay, then. Now, what are the underlying assumptions of capital asset pricing model? Please pay attention. This is very important. This is very examinable, highly examinable. Examiner can ask you to list or explain the underlying assumptions of capital asset pricing model. You have to know it. You have to know it. The first assumption is that investors are risk averse. Investors are risk averse, utility maximizing, and rational individual. What do you mean by this? When you say investors are risk averse, it means that investors do not like risk. Despite the fact that they don't like risk, they still want to maximize return. So utility means the maximization of return. And then they are also rational individual. Rational individual such that they have experience of the market. They know, they understand, they have the experience of the market and the investment they want to carry out. Nothing is strange to them. So they have what our market will react to their to our markets. They understand the market condition, the prevailing market condition. So they are rational individual. All right. So that is the first one. So we are saying that investors are risk averse, utility maximizing, and rational individual, which means that investor wants to maximize return, and then they understand the investment that they want to carry out. Then number 2 says that markets are frictionless. When you say markets are frictionless, it simply means that there is no transaction cost, okay? No transaction cost, and then there is no taxes, all right? This is not realistic. This is not a realistic assumption because there is no how you can make investment decision or you want to carry out investing decision and you are not going to incur transaction cost, because what this is simply saying is that you are not going to pay any brokerage fee, all right? No fee at all, which is not true because your portfolio manager is not going to work for you for free. You need to settle your portfolio manager. So you cannot say markets are frictionless, no transaction costs and no taxes. Once you earn return on your investment, once you make income on your investment, you have to pay tax on it, which that's what I said, that this assumption is not realistic. It's just in paper. For CAPM to be able to work effectively, that's why these assumptions are developed, not that it has any practical application, because most of all these assumptions are not realistic in practice. Then number 3 assumption states that investor plan for the same single holding period. That is, there will be only one time horizon, maybe a year. For example, all investors, they have one single year horizon. So, which is not true because we are different individuals. You may carry out your own investment this year. I may decide to do my own next year, right? So we cannot have in practice, we cannot have the same time horizon for our investment. So, but the assumption is saying that all investors, they are going to have one investment time horizon, which is single holding period. Then number 4 is saying that investors have homogeneous expectation or belief in terms of return, okay? So in this case, again, you cannot say all investors, as you have in this class, we have Ruth, we have Moses, we have Kemi, all of you in this class. This assumption is saying that all of you have the same expectation in terms of the return that you want to maximize. So the same expectation, when you say homogeneous, that means it's the same, which is not true in practice because we are different individuals with different expectations, with different aspirations, with different characteristics, and with different risk appetite. So we cannot have, it is not realistic that we are going to have the same homogeneous expectation that in terms of a return. It is not true. It is not true. But again, this is just an assumption. Then number 5 is saying that all investments are infinitely divisible. That is, yes, this is kind of a little bit realistic. If you say investments are infinitely divisible, that a fractional part of the investment can be undertaken, meaning that if you have 100 million naira, for example, that you want to invest, out of it, this 100 million, you can invest fractional part of it, let's say 30%. You can also invest 45%, whatever the percentage. So that's what this assumption is saying, that all investments are infinitely divisible. All right. Then the last one is saying that investors are price taker. Investors are price taker. Whatever the market gives to you, you don't have a say. You just you take it. All right. So these are the underlying assumptions. Ensure you master them. Ensure you master them. Memorize it. Understand it. Then, in case examiner asks you, you'll be able to do justice to it because it will be a bonus for you. It will be a bonus for you. You can imagine examiner is asking you to list or explain the underlying assumption of capital asset pricing model, and because you ignore it, because you don't know it, you are going to lose valuable marks. That will not be your portion. So they are very simple to, easy to memorize. Please ensure you do that. Okay, so without wasting more time, let's talk about how to estimate, even though we have done it in the past, how to estimate capital asset pricing model. How do you calculate CAPM? All right. Now, in the capping formula, there are two sides to the capping formula. We have the return part and also the risk part. Now, when you want to calculate the capital asset pricing model, you want to determine expected return of a given asset. Expected return is denoted as ROX, which is equal to the risk-free rate of return plus the beta multiplied by market return minus the risk-free rate of return. You familiar with this formula? We use it under cost of capital. Now, so this is the formula for calculating capping. Now, how do you then remember what I told you? There are two sides of capping. We said that capping is a model designed principally to establish the relationship between expected return of a given asset and then the systematic risk. So the risk aspect of capping is known as the beta, and beta measures how sensitive, or beta measures the sensitivity of an asset return to that of the market as a whole. When you want to measure how sensitive, the degree of sensitivity, all right, you want to measure the degree of change of asset return to that of the market as a whole, then that means you are calculating beta, all right. And there are three types of beta. We have positive beta, negative beta, and then zero beta. All right, zero beta. Okay, what do you mean by positive beta? Positive beta shows that the return of an asset follow the same direction of that of the market. Okay, when the return of an asset follow the same direction of that of the market, that means they have a positive, that means that's a positive beta. Okay, then the negative beta indicates that the return of an asset follow the opposite direction of that of the market. If the return of the market goes this way, the return of the asset will go the other way. So they are in opposite direction. So that means it's a negative beta. Then zero beta simply means that there is no relationship. All right, there is no relationship. Zero beta means the risk. The beta of the asset, zero beta simply indicates that the asset return has no correlation between with that of the market. All right. So when there is no correlation between the beta of the return, between the return of the security and that of the market, we say they are zero beta. Now, under zero beta, when you talk about zero beta, you need to understand that the risk of the market is always one. This is very important because that will be your basis. The risk of the market is always one. The beta of the market is always one. And anytime you compute your beta value, you are supposed to compare with that of the market. So that's what I told you, that this beta is always, the beta of the market is always one. So at all time, you are supposed to benchmark your calculated beta with that of the market, which is one. So if the beta of the security is higher than one, it means that the risk of the security is higher than that of the market. But if the beta of the security is less than one, it means that the security is less risky relative to the market. All right. If the beta of the security is one, that means the risk of the security is the same as that of the market. So you need to know all of this. Then, How do you estimate? In this question, in this material, you don't have alpha value. So let me use the working note to show you in order of frequency how I can usually test this area. So I will show you the 5 different formulas. You only have 4 formulas here, but I will show you 5 different formulas that you can use to calculate beta. Because on the day of your exam, where you are going to have challenge is how to estimate the beta value. Okay, because the beta value can be estimated in different ways depending on the information given in the question. So let me come here and show you calculating beta value. So like I said, there are 5 different formulas that you can use to calculate beta depending on the information available. So I'm going to give to you each formula based on the frequency in ICAN and how ICAN often tests the question. So the first one that is most common in ICAN is where you are given standard deviation and then correlation coefficient. Okay, where standard deviation and correlation coefficient are given. Okay, so in this case, the beta value will then be calculated as the correlation coefficient multiplied by standard deviation of the security over standard deviation of the market over standard deviation of the market. So this is the formula that you are supposed to use to calculate your beta value. So like I said, this formula will be used if in the question you are given standard deviation and correlation coefficient, which is R. Correlation coefficient R are given. Okay. Then the second one, the second most tested formula. Okay. The most frequent, second most frequent question under CAPM is where you are given covariance, where covariance and variance are given. So in this case, the beta value will be computed as variance of the security over variance of the market. Okay, I will explain the variables later on. I think somebody is sending message. What's the DM, sir? Don't worry. I will explain it later on. I will write it out. Let me finish the formula first. All right. So the third one, the third most tested or used formula is where you are given share price, where number of shares, market price per share, beta value of individual security is given. So anytime in a question, in fact, even this number 3 in recent time is tested more frequent than the second one, but let's keep it as it is. Now, in the question, you are given number of shares, you're also given share price, and then the beta value of individual security. It means that you are supposed to use the weighted average. You are supposed to use weighted average to calculate your beta value. In this case, there is a format, right? So the first column will be for companies that you have invested in. You create another column for number of shares, share price, market price per share. So you are going to have total market value. You create another column for beta value of individual. Then you create column for the weights. This is beta. Then create a column for the weights. All right. So let's say this is A, B, C equal to, let me write that. C equal to A multiplied by B. Here is D, here is E. E is equal to B times C. Okay, to make life easy for you, so this format should be sufficient. Okay, let's say you have investments A, B, C in the portfolio. Okay. So here will be total. So the number of shares of each security will be given to you. Market price will also be given to you. To now get the total market value, you multiply the number of shares with the market price per share. So to get the total market value. The beta value of individual security will also be given to you. To get the weight, then you need to multiply the market value with the beta value. Okay, so that is, sorry, I wanted to say C multiplied by D. This is C multiplied by D, C multiplied by D. All right, so then you add up everything. So to now get the beta value, the overall beta will then be equal to total weight divided by total market value. So that will give you the beta of the portfolio. So this is another way of calculating the beta value. All right. Then number 4, if in the question you are given this number 4 and 5 is not common, but again, let's put it down. You never can tell. Maybe examiner will ask you this time around. You may be given where regression analysis, information is given. Okay, so in this case, you are supposed to use regression formula. Mr. Ashiwaju, okay, for those of you that are writing a performance management, Mr. Ashiwaju would have taught you how to establish relationship between fixed cost and variable cost using high and low method. Under high, you can use either high and low to segregate variable from fixed, or you use regression analysis, calculating slope. So that slope formula is the same thing you want to use here, which is n summation xy minus summation x multiplied by summation y over n summation x squared minus summation x all square. So this is the formula. This is the regression analysis formula that we are going to use. I will define the variables. Let's move to the last one. All right. This last one is used when you are given excess return. So you use this one where excess return, let me just put it down. Excess where excess return on security and markets are given. So in this case, the formula to use to calculate your beta value will then be equal to, let me write it down. Let me do it this way. Excess return on security over excess return on the markets. Okay, so the excess return on security is your expected return minus the risk-free rate of return. The excess return on markets is the return of the markets minus the risk-free rate of return. So these are the 5 different ways in which you can calculate the beta value. So let me now define the variables, okay, where I started with, let me see, number 1, I started with, okay, let me just write it by the side so that I don't go too far. R equal to correlation coefficients. Instead of going down there, let me just write it by the side. DS is equal to standard deviation of security, standard deviation of security. Then DM, Simon, you are the one asking for DM. DM is standard deviation of the market. Okay, standard deviation of the market is DM. Next one. Here, the covariance. This is covariance of the security then dm squared simply means variance of the markets. Okay, then what else? In this one, MPP simply means market price per share. TMV simply means total market value. Let me give space. What else? The last one, Nothing again. Yeah, this other side, n equal to number of period. It could be in months or days or years. Then x simply means return of the market or market return. Return of the market, that's your x. Then y, return of security. Security. Okay, so that's that. That's that. So I've defined all the variables. Now, the last area we are going to touch base under CAPM would then be estimating alpha. Let's talk about alpha. This is also, in fact, this is in recent time, this is the most tested areas of CAPM. So let's talk about estimating alpha. Estimating alpha value. Okay. What do you mean by alpha? It's not in your notes, so let me put it down for you. Alpha, denoted as, represents the difference between the expected return, and required return of a given asset, or security. Okay, it can be calculated. First, let's stop all those story. I will be very happy if I can solve one question under CAPM, so that in our next class, I will solve more illustrations. So we said alpha is equal to difference between expected return and then the required return. Okay, so we can use table to do this. In this case, this is the formula that you can use to estimate your alpha. You create a column for companies in the portfolio, create a column for expected return, required return, then your alpha. So you need to interpret your results. So you can give this one as a remark or comment. Anytime you compute, let's say this is A, this is B, C equal to A minus B. So anytime you compute alpha, you have to interpret your result. It's not sufficient for you to just go ahead and calculate alpha without telling your clients what you mean by your results. Okay, let me give you the format first before we talk about interpretation. So let's say you have security A, B, C in the portfolio. So you are going to be given the expected return. You are the one that will estimate the required return. So just get your alpha, you put in your comments. Now let's talk about the interpretation. After you have computed your alpha, you need to interpret your results. So I will then come here, interpretation. There are 3 different ways you can do this. Interpretation. Okay. Number 1, if A is greater than B, that is, if expected return is greater than the required return. Okay, this A is greater than B. A is greater than B. Let me put it this way. A is greater than B. The result, it means that the security is underpriced or undervalued. If A is greater than B, it means the security is undervalued or underpriced. It means the security is undervalued or underpriced. This will produce a positive alpha. This will produce a positive alpha. Therefore, when this happens or under this circumstance, when this happens, the security, more of the securities should be bought. More of the securities should be bought. So once you calculate your alpha and alpha is positive, it means that the security is undervalued. All right. So it means that the actual price of that security is less than it's less than the intrinsic value. It's less than the intrinsic value. So in this case, you need to buy more of that security so that when the prices changes or favor you in the future, you dispose it off to make more money. All right. So for the purpose of your exam, once your alpha is positive, it means the securities is undervalued. If the security is undervalued, what do you do with it? You buy more of the security. You buy more of the security. Then number two, if A is less than B, this will produce a negative alpha. This will produce a negative alpha, and it means this will produce a negative alpha, and it means that the security is overvalued, or overpriced. When this happens, what are you supposed to do? The security should be disposed of. When this happens, the security should be disposed of or sold. Or sold. So that's what you need to do. Anytime you compute your alpha and it produce a negative, when you have a negative alpha, it means that the security is overvalued. If the security is overvalued, what are you supposed to do? You sell it off. You sell off the security. So that's what you need to do. Yeah. So all those ones are underlined are the key points. Then the last one, number 3, if expected return is equal to the required return. So this will produce 0. This will produce 0 alpha, which means that the security is properly priced. The security is properly or rightly priced. Since we are using value, so properly valued. Then what are you supposed to do? Therefore, the security should be kept. The security should be kept. Okay. So these are the 3 ways you can interpret your alpha value. These are the 3 ways to interpret your alpha value. Now, note the required return RS is calculated as alpha. Sorry, it's calculated as CAPM, or is calculated using CAPM formula. Using CAPM formula. That is RS equal to the risk-free rate of return plus beta into market return minus risk-free rate of return. So this is anytime you want to. Now, on the day of your exam, if you are given any question under and you are asked to calculate alpha value, the first working that you are going to do is to calculate your beta value. You see, it's the problem, like I mentioned, the issue the challenge that student will face under this topic is not as per the expected return, or sorry, the required return that you want to calculate. The major challenge is your ability to be able to identify from the question which formula that you are going to use to calculate your beta value. All right, that's the major thing, because the required return is there. You already know the formula, but this beta value will not be given to, in most cases, the beta value will not be given to you. So out of the 5 formulas I've given to you some minutes ago, out of those 5 formulas, one of them is what you are going to use on the day of your exam. And that's why it is important. You just have to memorize the entire 5, because you don't know which one is which. You don't know which one examiner will set for you on that day. And that's why you have to memorize all the 5 formulas. So once you see in the question, you are given standard deviation and correlation coefficient. That means you have to use the first one. And I said that this first formula is the most frequently tested kind of a question. So once you see in the question, you have standard deviation and correlation coefficient. So that means that's the formula you are going to use to calculate your beta value. If in the question you are given covariance and variance of the security and that of the market, then you use the second formula. If in the question you are given share price, you are given number of shares, you are given beta value of individual security, and the examiner is now asking you to calculate the overall beta, then you use this third formula, which is total weight over total market value. And how to get the total market value and the total weight is what you have in this format. All right. So you have to know all of this. You have to know all of this. Then in the fourth one, to calculate your beta value, if you are given regression analysis information, then you use the fourth formula to calculate your beta value. And that's all you need to do. That's just what you need to do. All right. So in most cases, when you're calculating your alpha value, when you're calculating your alpha value, the expected return will always be given to you. This guy will always be given. Expected return will always be given. You are the one that will calculate the required return using the CAPM formula. And when you are doing this, the first thing you are going to do is to calculate your beta value using any of those five different formulas. Once you get your beta value for each of the security, then you can then go ahead and calculate the required return. It's as simple as that. It's as simple as that. So, uh, okay. So this is where, let me know if you have any question. Let's call it a day so that in our next class, we just solve questions. If I can solve like 4 or 5 illustrations on that day, so that will be fine. That will be fine. Yes, Ogechi, talk to me. What's your question? Okay.
I just wanted to know the meaning of RS is return on security, RM return on market. What of the RF?
You said, did I say RS is return on security? I said required return. See it now. RS is required return. RF is risk-free rate of return. B
Okay.
is beta value. RM is market return. The difference between RM and RF is called risk premium. We have done this previously now. Okay. We did this under cost of capital now, right? So, yeah. Okay. Let me know. We're not going to do any calculation today under CAPM. In our next class, we just solve calculation straight. Let me know if you have any question for me so that we can close the class. All right, let me see those of you that are, I have not heard of, what's her name again? Angela tonight. Angela is not in this class. Let me see. Those of Ada is still on. Ada has changed her name from the Zoom user. Okay, I still have David. Yes, Anete. Ruth is still on. Glory, Grace Luca, Ahmed. Ablatif did not join the class tonight. Chill is still on. Then I still have Priscilla. Priscilla, how is your hand over there? Hope you are catching up. You are getting used to the environment. Priscilla. Then Kevin is still on too. Aureoliwa, Rose. Hi. What's her name? Laura has disappeared. I remember Laura has disappeared. So Samiat is still on. It's okay. Moses too has disappeared. Siam, he has disappeared because I said I'm not going to solve question tonight. He now disappeared. No problem. Okay, guys. In the absence of no further question, I want to say thank you to all of you for your patience and taking time to join the class. Next week, by the grace of God, is it? Yes, it's next week on Monday. No, on Tuesday, we are going to have, we continue our class. All right. Good night, everyone.
Good night, sir. Thank you,
Yeah.
sir.
Night, sir. Bye.
Yes, sir. Thank you, sir.
Good night.
Thank you, sir.
Yeah, okay. Good night.
Good night,
Glow, good night.
sir.
Yeah, good night. Okay.
Thank you.